Hey guys, welcome to another video with Magic Gains. In today's video, I will talk about options Greek. I recommend watching the whole video since this is a very simple way to explain options Greek, and if not the simplest. By the end of this video, you will understand them, and that will allow you to increase your portfolio and your options profit every time. So before we get started, don't forget to hit the like button to support this video. Subscribe if you have not done so already. Don't forget to hit the notification bell, and lastly, leave your comment below and tell me your thoughts about this video. In the previous videos, I shared some useful tips and strategies to grow your portfolio with options trading, so feel free to take a look. The link will be in the description below and as well as at the end of this video. First of all, what are options Greek? The option Greeks is a term used when trading options to calculate the level of risk that is being taken in an option position. They are called Greek because they are basically from the Greek symbols. They can be found under your option contracts if you scroll down on your phone or your computer. So many people often ignore the Greeks when trading options. But remember, they do play an important role in determining if a particular option is a good buy or if the risk level are worth taking. The first Greek we're going to talk about today is the delta. So what is the delta? The delta is directly correlated with every $1 move in the stock price. For call option, the delta ranges from 0 to 1. And for put options, the delta ranges from 0 to -1. So for example, if we buy a call and our delta is, let's say, 0.20, when the stock price increases by $1, the options price will go up by 20 cents since our delta is 0.20. So that dictates how much the option value increases for every $1 move of the stock. And the same thing, if the stock price goes down by $1, the option value will go down by 20 cents. So since our delta ranges from 0 to 1 for calls and 0 to -1 for puts. So now when we buy a put option, our delta will be negative. So the range for put is 0 to -1. So when you buy a put, don't be surprised if the delta is negative. So the same concept applies when you buy a put and when you buy a call. So the stock price goes down $1 and your put options will increase by 20 cents, because remember, when we buy a put, we want the stock price to go down. So if the stock price is going in the direction we want, so we gain 20 cents value on our option. And the same thing, if the stock price goes up in the opposite direction, we lose 20 cents on our option. So as you can see, this is how delta affect your options value. And by understanding how delta affect your option price, you can be more careful to pick which options that's gonna make you profit based on the specific delta number. So our second Greek for today is the theta. So the theta shows the correlation between the price of the options with time. So basically the time decay of the option. So the theta itself tells you this is how much your option is gonna go down by every day that passes. Every day that passes, you getting closer to the expiration date. So this is the amount you will lose every day, right? So for example, let's say we buy a call and our theta is, as we can see here, 0.20. So the options price will lose value of 20 cents every day that passes. So if you are getting closer to the expiration date, you are losing 20 cents every day, and it might be higher. But if you have a long call, a call that expires in a longer time period, your theta will be more likely lower. Especially if you're at the money, your theta value increases. That's when your theta value reaches its maximum. But out of the money or in the money, your theta value decreases. So because when you're at the money, your stock price have a higher chance of moving from that price, right? So the more it moves from that price, from the at the money price, the more you lose money and the faster you can lose money, right? So basically the theta is higher at the money and the options value goes down faster. And higher theta is a big drop in your options value. Lower theta, you have a small drop in your options value, which always go for a longer time period options. So as you can see, when buying an options, you need to be aware of the theta of this option. So good theta means you have it's lower. Bad theta means it's higher. So especially if your expiration date is approaching, the lower the theta, the better for you. Our third Greek example here is the gamma. So basically the gamma tells you how fast the delta, which we discussed earlier, is going up or down as the stock price moves or as the stock price changes. So in other words, it tells you how much the delta increases or decreases every time the stock price goes up $1 or goes down by $1. As our example show here, we have a stock price, let's say at $10. So our delta shows at 0.20 and our gamma is at 0.05, right? So in the end, every time the stock price moves $1 up or down, we will have 0.05 change in our delta. Let's say, for example, our stock price goes up by $1. Our delta will increase by 0.05, which will increase our options by 25 cents since our delta is now 0.25. And the same thing if the stock price goes down $1. This will decrease our delta from 0.20 to 0.15, right? So our options value will go down 15 cents. So basically the same way our delta dictates our options value based on the change of the stock price, our gamma dictates our delta based on the change of the stock price. So our gamma is our delta's boss and our delta is our options' boss. So the smaller the gamma, the more stable the option would be, right? So if you want an options that doesn't have a high volatility, you would need a smaller gamma since the gamma dictate our delta, which dictate our options. So if the gamma is higher, the options value will decrease or increase in a larger amount. So you want a smaller gamma if you need less volatility and higher gamma if you need high volatility. Our fourth Greek for today is the Vega. The Vega shows the correlation between implied volatility and options price. So basically, you can look at how the implied volatility is moving to know how your option will do in the future. So basically, it's the amount option price goes up or down based on the change in implied volatility. So let's say, for example, we have an implied volatility of 15% and that goes up to 16%, and that will increase our options by however the amount of the Vega is. If Vega is 0.10, for example here, our option will increase by 0.10, which is 10 cents. And the same thing if the implied volatility goes down to 14%, our option will goes down by 10 cents since our Vega is 0.10. So that dictates, the implied volatility dictates the change of the Vega, and the Vega dictates the change in our options value. And finally, our fifth Greek for today is rho. Rho might sound a little weird, but rho shows the correlation between option and interest rate. So an increase or decrease in our options value for every 1% change in interest rate. So in our example here, we have a call option that is worth $1 and our P value is, or rho value is 0.02. So every time interest rates go up 1%, option call value increased by 2 cents since our rho is 0.02. And every time interest rates go down by 1%, our call options go down by 2 cents, lead up to 0.98 or 98 cents. And the opposite is also true for put options. So every time interest rate go down, put options go up, and every time interest rates go up, put options go down. So here we go, guys, for a real example of one options that I bought a while ago for VNQ, which is an ETF. And for this option, my expiration date is June 17, 2022. So I basically have a long time to go with this option. And here, let's go straight to the Greeks. The first one in our list was the delta. So the delta, remember, the delta tells us that our option will increase by this amount, right? So let's say, for example, the stock price go up by $1. Our delta tells us that our options value will increase by 60 cents. And if it goes down by $1, our options value will decrease by 60 cents. And then the same thing, the second one in our list was the theta. The theta tells us how much we are losing every day as the expiration date is coming to us, right? So in this case right here, I'm barely losing any money since my theta is negative. So as I am approaching this date as of right now, I'm barely losing any money with theta. So let's say we were in May 2022, this would be surely very high. And thirdly, we have gamma. The gamma tells us how much our delta will be moved by, will changed by. So in this example, our gamma is 0.02. So every up or down move in the stock price, delta will be changed by 0.02. In this case, if the stock price goes up, the delta will move up by 0.02, which will be 62 cents, right? 0.62. If the stock price goes down, the delta will go up still by 0.62. If the stock price goes down, which means that our option will go down by 62 cents as well. And thirdly, we have Vega. The Vega literally tells us how much the stock price will be moved based on implied volatility. So if the implied volatility go up, our Vega tell us that by 1%, specifically by 1%, our Vega tells us that our options value will increase by 30 cents. And if the implied volatility goes down by 1%, our options value will go down by 30 cents. And the row basically have correlation between the interest rate and the options value. So let's say, for example, the interest rate goes up by 1%, which is 1% of 3. That means our options will go up by 30 cents. And if it goes down 1%, which means 1% of 3, again, it will goes down by 30 cents. So interest go up, row tell us that our movement in the option will be 30 cents, and it goes down, our movement in the options value will also be 30 cents. So that's it for this video. Thank you guys so much for watching, and thank you for supporting this video with thumbs up. And I hope this video brings a lot of value to you and that you learned a lot today, especially those who do not know how to use the Greek values in their interest. So I hope this video is a big help for you. Thank you very much for watching, and I hope you enjoy your profits and invest safely.